So we have a very interesting, session which is coming up. I work closely with the IIT Mandi, and while we were putting together this Himalayan startup trek, we thought, what is it that is of utmost importance to all these startups, which is money and need for money, and you need to demystify that world, right? Because it seems so complex, and how do you go and ask for money, and how do you get funded, and so it seems a very complex world out there. So we thought we'll put together a panel which can try and demystify this world for you a little bit and simplify things as to how they work. So, and I'm extremely pleased to have the three panelists with me. Two of them are from IIT Delhi, and so am I. So I'm very pleased about that as well. Let me introduce Vikram Gupta. Vikram, please, would you come on stage? Vikram is founder and managing partner for IvyCap Ventures. He has over 20 years experience in venture capital, business consulting, mergers and acquisition, strategy and technology in the healthcare, life sciences, education and consumer sector. He is known for setting up India's first healthcare and life sciences venture capital fund and successfully investing across the sector. Previously, he also managed the clinical genomics practice for IBM's healthcare and life sciences vertical in the US. He has also been an entrepreneur himself in the areas of technology and healthcare. Let me invite my second panelist, Nilesh Jain. Nilesh, would you please come? Thanks, Nilesh. He's venture partner at Z Nation Lab, and Z Nation Lab and Catalyst are doing a bunch of stuff together. Nilesh is currently a venture partner and a passionate technology evangelist at Z Nation Lab. He's director at PicoStone, which works with a mission to automate every home in India. Mr. Nilesh Jain is Managing Director, Investor at HOWL, a full-stack e-commerce and digital marketing solutions company. He holds a master's degree in computer science from Carnegie Mellon and an MBA degree in operations and finance from University of Pittsburgh. And he also told me that in his personal capacity, he has invested in 21 startups. So he's also an angel investor. Okay, let me invite my dear friend and my third panelist, Rajesh, Krishnan, Raman, to the stage. Thank you, Rajesh. Rajesh is a dear friend. He's my batchmate from IIT Delhi, and he was here for a vacation. He came visiting me, and I said, okay, I'm going to make sure that you come and speak on the panel with me. So here he is. He's the founder and CEO of Brick Eagle Group. Rajesh promoted Brick Eagle in 2011 with a vision to deliver 1 million affordable homes in India. He has incubated 5 developers and 8 service providers in the affordable housing sector till date. Rajesh started his career with Schlumberger Oilfield Services as an engineer and later as drilling services manager. He was an investment banker with Lehman, Nomura, and later worked as regional head for South Asia for Structured Solutions Group for Standard Chartered Bank. He is an alumni of IIT Delhi and Wharton School. Thank you to all three of them. The way we thought we will run this panel is all of you are, pitching for the business plan competition and looking to get incubated. So I'm sure you have lots of questions. Some of you are early stage. Some of you have been running operations. You have some revenue to show. Some of you have proof of concept. And some are just at an ideation stage. And if you look here, I guess all the three panelists have, in their personal capacity, either invested, raised funds, or are investing. I think what Rajesh runs is sort of an incubator for affordable housing in the country right now, and I know he has raised funds and he's investing those funds. Again, if you look at Nilesh, what he's doing is again, of course, he's a partner at Z Nation Labs, but he has also invested money in his personal capacity. And Vikram is very well known with IvyCap, what he has been doing. So I think their experience is very well rounded. From, they themselves became entrepreneurs, they raised money, and now they're helping other people become entrepreneurs by investing that money in these startups. So I think you can ask them questions from any spectrum of finance and fundraising, and I'm sure this panel will be able to do justice to that. Just to kickstart the panel, what I can do is I can probably ask one or two questions, and I'll ask all three of them to respond to that. And subsequently, you guys can jump in and ask your questions as well. I think there are two things. I have been in a similar boat. I have been a non-profit entrepreneur myself, and I've been part of a startup, and I'm continue to be part of a startup which is a mid-sized firm right now, Fractal Analytics. I think some of the things which I always thought about was first of all the lingo, which is very confusing. There is seed investing, there is angel investing, there is incubation, there is acceleration, there is venture capital, there is Series A, Series B, there is private equity, and a lot of us get very confused with this, right? Whom should I go to? How should I network? What should I ask for? So that is one thing. If the panel can throw a little bit light on just to explain and demystify this world of what happens at what stage. That is one question that I had. The second thing is, what is it that investors are looking for in a firm when they take that decision that we're going to invest in them? And the third question which I had was around valuation. So you'll see startups which come and say, okay, I'm valued at $10 million, and they won't even have a proof of concept. So what are the rules of the game? Is there a rule at all? I mean, at all in the valuation space or not? And how does that work? So how should you think about your businesses as you take it forward, and while you go and talk to people who are going to fund it? So how should you think about valuation? So those are the three questions to get kick-started, and then we can go from there and ask more questions.
So let me start with your first one in terms of what are the different stages, fundraising and the business life cycle, especially for initial stage of the business. So very clearly, when you're starting a business, your first port of contact are basically your friends and family, right? So people who know you and people who trust you. It's a game of trust. Effectively, if somebody has to give you money, the biggest trust comes from people who have known you for a while. So it could be your parents, your siblings, your relatives, your close friends. So your first money always comes from such people. The second, so once you have, conceptualize an idea, and then now you want to start working on it. You may be developing a product, or you want to do some initial testing. So of course that's where the money comes from. Once you've taken off with that, with the idea, and you actually shown the seriousness, maybe partner with someone, or maybe doing it alone, you start talking to a set of other professional people. Your next port of contact is basically angel investors, and these are typically either organized angel networks, or people who again could be coming through your own networks, who actually invest as angels. So once that happens, of course, next stage now in India, I think there's another stage which has been inserted between angel and Series A, is called pre-Series A. So something very interesting which has come up as a new terminology. So typically, I think it's more to do with the size of the check and the stage of the business, etc. So typically at that stage, you're looking at about $1 million kind of a ticket size. At the friends and family, and people call it 3F, friend, family, and fools. So that round is typically, dependent on what you need initially. It could be a few lakhs, maybe up to 10, 15 lakhs. Angels could go up to 1 crore, 2 crore, these days going up to even 3 crores, or sometimes even 5 crores as organized angels. And then pre-series about $1 million or so. And then Series A or Series B, which is where typically we as IvyCap Ventures do most of our funding, even though we have a separate platform called IvyCamp, where we do seed stage funding as well. So there we start with a check of about 10 to 12 crores, so roughly about 2 million on the lower side, and we could technically go up to 7 to 8 million per company. And we do that because that's by design. We want to invest in a few companies. We want to work very closely with them and help to scale them up. And that's typically done at a stage where you already have your MVP, you have some market established, some traction has already started building up, and your unit economics has been established. So with that funding, then you start really taking it to the next stage, which is typically, at the stage where you go to market, or scale is now being defined in terms of particular geographies or particular product category or expansion in different areas. So that's when you go for Series B, and then Series C typically is at the time when either the profits are already in or the profitability is fully established. So that's typically, and then of course after that, it happens based on, there are multiple rounds that happen. Most of these unicorns would have raised Series F as well. So that's the multiple stages of funding. Now, on the second question in terms of what we look for typically, of course, the criteria is typically very different, I would say, at each of these stages. By this time you reach Series A, I think the criteria changes quite a bit. Of course, and of course you will see different parameters at each of these stages, even in terms of valuation of your business, in terms of the terms. We heard this morning from Game Changer. It was very interesting to hear all these things, and thanks a lot for giving all that, because I have seen many times that entrepreneurs do not understand these terms, and at times they end up making lots of mistakes, and end up negotiating on things which do not really matter, and end up giving away things which are actually very important to them. So I think it was very good to hear the way you explained it. Was very nice. So I think at Series A stage specifically, for us, all those terms, etc., become extremely critical, especially because, a venture capital fund, one important thing to differentiate and understand for you guys is a VC capital or an institutional capital is third-party money. So I'm actually managing somebody else's capital. So I actually go to the market, convince a large number of people, ask them to put money in a blind pool. Just imagine when I go to raise money, my pitch is like this, give me your money, I'll manage it, don't ask me where I'm investing, I'll charge you 2% for it, I take 20% of the profit of upside, if I lose your money, I'm sorry. So it's pretty much like that. So imagine, it's a one-sided deal, so therefore it's pretty much, imagine the kind of trust I have to build with them, right? So I'm actually really putting a huge amount of trust out there when I'm taking their money and putting it to a blind pool. So once I put that money into a blind pool, now imagine the amount of responsibility I have to make sure that, I invest that money in such a way that I'm able to return that money with the kind of expected returns. When they're actually doing that, of course, they're expecting very good returns. So, they're expecting returns better than what they're getting in their own initiatives or businesses or whatever they are doing in liquid markets. In this case, another problem is that, when they're giving me money, so I just tell them that don't ask me for next 7-8 years where your money is. Don't forget it. So imagine, this is the toughest sale. You're selling a venture capital fund. So therefore, what it translates to is that when I use that money from that bucket to invest in people like yourself, imagine the level of responsibility I have. So therefore, the level of due diligence I have to do on various things, including the credibility of people I'm investing in, because every time I make an investment, I'm actually defining my own personality, because I'm partnering with you. Therefore, every investment I make is basically put there on my resume, right? So which means I'm actually defining my own personality every time I'm making an investment. So effectively, the kind of due diligence I have to do is very rigorous. So all these things that we talked about in the morning, financial, technical, commercial, legal, we go very deep into that. And then the most fundamental thing is exits. So of course, for me, since I'm managing somebody else's money, and I've told them that, look, I will make my best efforts to return your money. But I have to, if I don't return that money, you know, my career is over, right? So that's it for me, right? So this is, then I have to look for a job or maybe do a startup like you guys and, you know, go and make my pitch to somebody else and do something similar. So, so therefore, it's extremely important to define an exit time frame for me. So I typically look at 4 to 5 years as my target time frame. So all these clauses which you were talking about, drag along, tag along, liquidation preference, these are all to basically protect myself to get my returns. So what I look for are 4 things basically. Whenever I, you know, look to invest in an entrepreneur, number 1, I look for the space. So I look for the big picture in terms of the product market fit. You know, is there enough, you know, white space out there? You know, what's the kind of differentiation which is there in this particular business? So that's the first thing I look at in terms of the gap which exists out there in the market. The second thing I look at is the team. Now, team is extremely important for me. So that's why, you know, I mean, of course, as I said, you know, there's a lot of trust which we are putting there. So the credibility of people involved, the team dynamics is very important for me. When people are, there are 2 or 3 people working together, and you know, depending on the relative stakes they have, it's very important to watch them for some time. So that's why we take some time before we actually make the investment. We watch them, how they behave with each other, you know, how they're taking decisions, who calls the shots. If there is a deadlock, who's really taking that call? You know, what backgrounds do they have? Are they experienced enough? So lots of things that go into really identifying the right team. The third one is really understanding the key assumptions which go into the financial model. So that's something which I personally spend a lot of time in actually understanding, you know, and that actually reflects the maturity levels. In fact, it boils down back to the team's maturity levels. So typically people say, you know, I'm a startup, you know, how can I forecast for next 5 years? I don't know, the world is changing so fast. Why should I be, you know, projecting my financials for next 5 years? For us, it's basically how you think about it. You know, it's about reading your mind. It's about understanding your maturity levels. When you're actually putting your assumptions, you're actually giving away how much you know about this market, how much you know about competition, how much you know about the pricing models that are going to work. So it's more about understanding very specifics out there. And the last but not the least is basically the exit potential. And when we are looking at any investment for us, if you're looking at a 4 to 5 year time frame, we are not expecting an IPO to happen in that time frame, because when we are investing, it's still very early. IPO may still take a long time. So we are very specifically looking at an M&A as an exit. So that's why, you know, when we talked about this 10% versus 90% stake of, if, you know, I usually don't take 10%, I take about 25 to 30% minimum. And I play a very active role on the boards, and I bring a lot of value. And my sponsor is the IIT Alumni Trust. So just to let you know, the way my fund is structured, I actually went and raised my money from IITians. When I started in 2011, the first thing I did is I actually, just exactly for the same reason, for the trust building, right? So if you were to go and pitch that story which I just told you, that, you know, forget your money for next 7, 8 years and I might even lose it, and if the upside also, I would have a share in that. The only people who will probably give you that money in the beginning is probably IITians, your alumni, who would trust you, because when I'm saying IITians is because you're fellow alumni. You may be not from IIT, but if you're not from IIT, you're from some other institute, your alumni will have more trust in you as compared to, you know, some other alumni. So I think that's the connect we actually captured, and we were able to raise 240 crores in the first fund and 600 crores in the second fund. Today we are the largest homegrown venture capital fund because of that. But I think these 4 criteria is actually really what we look for when we identify investing in entrepreneurs. Valuation. So Now that's a very interesting discussion. I'm sure everybody has their own views on that. So valuation is very different at different stages. The concept of valuation is, it has multiple implications, right? So one implication is more about how much you want to dilute. So it's more about, as a principle, when you're raising capital, how much you should. So it's a function of how much capital do you actually need versus how much do you want to dilute in your company. And there are, of course, lots of other parameters in terms of the business model, the scalability of the business model, the profit parameters. Of course, ultimately comes down to what kind of cash flows will, get generated in the business over a period of time. But, at that stage, it becomes extremely difficult to project those cash flows. So at Series A level, typically, we would look at, if we are putting in 15 crores as an example, let's say the business is doing about 1 crore a month. The nature of the business is such that with that money, it will grow up to maybe 5-6 crores a month, or maybe up to 7 crores a month. So I typically look at when I'm going to the market to raise money at that stage, because even at that stage, they will look at maybe next 5 years, because whoever comes at that stage will again look for their next 5-6 years. If somebody is coming at Series B or Series C, they will look at another 5 to 7 years for their exit. So therefore, I even look at a 10-year time frame and see, what kind of value will play out after I exit. And in that time frame, what kind of multiplier am I getting on my investments? So that's one of the criteria. So of course, there are multiple things involved. There's not just that one factor involved. So this is just one example I'm giving you. There is also, of course, a lot depends on the quality of the team. Sometimes the good quality teams get very good premium on valuations. So the teams are, like for example, I think this ex-Myntra guys, and they just came up with just a paper plan. They got funded with a very good valuation on a paper plan, right? So, ex-successful entrepreneurs, when they start their business, they have a track record. So typically, they are able to command a premium because they've done it before. So they're able to justify that the risk involved with us is much lower. So therefore, they're able to negotiate that. But I think typically one of the ways where you are confused, that you don't know how to value a business, and you're only looking for a round towards a larger round. I usually recommend that don't value your business today. Just discount it to the next round. It's not right sometimes. What happens when you try to value a round at a point where you are trying to reach to the next level, and the next level may not be too far away, then you'll be making a huge mistake by actually valuing it at that point, because either you overvalue it or undervalue it. If you overvalue it, it's going to be extremely hard to go and convince your next set of investors that you now invest at a value higher than this. If you undervalue it, the chances are that somebody who's putting money ends up getting a huge stake in your company, and the next round investor will actually not like it at all, that somebody who's actually working on the ground is not incentivized enough. So I had entrepreneurs coming to me with the 30% stake, and the angel investors holding 70%. I think everything was good, but I think I didn't invest in them. I'm sorry I've taken so much time just trying to answer all these questions, but I guess I'll.
Thanks a lot. How many of you all here in this room are looking for funding or have gotten funding? So looking for funding. And how many have gotten funding or raised some amount? Okay. So to answer your first question, at what stage you are, I think my question to the entrepreneurs are at what are you trying to sell to the investor? Are you trying to sell yourself, the concepts that you're trying to put together? Have you made it into a business? Do you have a POC? Right? Are you revenue generating, cash flow positive? So there are just different levels of conversations that you have given the point of the business that you're in today. Right? And that will define as to what your round is going to be, what your valuation is going to be, what your size of the valuation is going to be, and the size of funding. I typically invest very early on, which means you have a concept. I look at the background of the founders, what they've done, what their passion is. Sometimes I even ask them a question: what time of the night do you sleep? Right? It tells me about the founder's attitude towards the company that they're trying to build. So at the early stage, it's very difficult to define valuations, to your point. So it's sometimes very difficult to define valuations in an early stage. And we go through these discussions umpteen number of times throughout the month, right? As to what is the right number, how much you're willing to dilute, right? And what's the next stage of funding is going to be, right? How confident are you to take the company to the next stage? So very often we'll look at companies that are very early stage, no POC, even the MVP doesn't exist, so your valuations are not going to be that high. But given what you do with that money in the next 6 months to 12 months, that will define your valuation for the next round. Whether you've done your MVP, whether you've done your POC, whether you've gone and acquired customers, you've proven your model, right? Also, I ask a lot of entrepreneurs, if you're thinking of doing a Series A, Series B, Series C, go back to the drawing table and ask yourself, is your business going to be worth 500 plus crores in the next 5 to 7 years? If it is not, you're going to have an extremely difficult time going through the next round of funding. So make sure your business models are sound, make sure the product, the concept, the services that you're trying to offer are well sounded off. You're addressing a niche, you're addressing a market that you know you'll be a long-term player. Competition is always going to be there. How you differentiate from the competition will be more important. Right? What I look for in the entrepreneurs is passion, their background. I also look at the business space, not what is there today, but 5 years in trajectory where the business and the market is going to be, especially for the products or the services that the startups are trying to offer. From a valuation perspective, I think it's a very open-ended question. It goes back to how much you're willing to dilute, whose money you're willing to take, and then how long you're going to take to go on to the next round. So there are multiple factors, and each case is different. Each company is different in terms of valuing their business and looking at what kind of dilution you're willing to take at that moment.
So I guess you guys have covered most of it. Let me kind of see what I can add. See, for what it is, we are a platform for affordable housing. Yes, our vision is to go and figure out how we can deliver 1 million homes. So everything that we do kind of hinges around affordable housing. So we invest in developers, we invest in construction technology companies, we've invested in some tech companies doing interiors and so on and so forth, right? So the point I'm trying to make is investors have a theme. Okay, many of them, most investors say, man, I like these kind of themes. Right? So before you spend too much time with an investor, just ask the guy, man, what kind of stuff do you like doing? Right? And so if you can come up with like a really sexy healthcare idea, chances are I'm not going to invest, right? Regardless of how smart you are and what a wonderful business plan you have, right? So I'm saying the first thing is figure out, before spending too much time, ask the investor, hey, what are the themes that you invest in? What kind of sizes you invest? What is the timing? Do you come early? Do you come late? So you'll soon get an idea of whether or not this investor is the right guy for you before you spend too much time, right? And also when you're speaking to an investor, you should also think about what value they can add, right? While it looks like you're happy to take the first check that comes at this stage, don't fall for that craving. Basically, see what value the investor can add, and also see if there is a meeting of minds. Look, once the investor puts money, you're going to spend a lot of time together, and if you guys are not in the same wavelength, chances are it's going to be a very horrible experience. Chances are the company won't succeed. Yeah. So, and because there are a lot of investors out there, they may not be professional investors, they may be family offices, and there may be a munim sitting in your board telling you what to do. So,
You can also ask them what time do you sleep.
Yeah. In fact, you know what? Before you take anybody's money, ask them, hey, what kind of companies have you put money in? And speak to one of those entrepreneurs and check out what experience they had. Right? And trust me, you learn a lot about those guys. Yeah. And when it comes to valuation, it's a crapshoot, man. That's what we'll tell you. All right. So I'm sure we'll come up with like really complex kind of algorithms to justify valuation. But look, the fact is nobody has a clue. All right. What this means is an opportunity for you to negotiate. All right. You guys better get somebody on your side who will basically fight on your behalf. Just to give you an example, right? There's a guy I know, really solid guy, fantastic entrepreneur, right? And first he basically came and said, hey, you know what? Why don't you give me 2 crore rupees? I'll give you 50% of your company. I said, okay. Then, 3 months later, he meets a guy who says, man, I'll put 20 crore rupees, give me 70% of your company. And in fact, I think he's asked for 90% of the company. And he says, man, do I really want to sell out for 20 crores before I even start the company? Perhaps not. So then he says, okay, I'll do 50% of my company for 10 crore rupees. Right? And then later on he settles for like 30% of the company for 4 crores. I'm saying all of this happened in like 2 months. Right? So what's the valuation, right? Is it 2 crores or like 30 crores? I mean, come on, man. No. So our point is, I mean, especially for you guys who are doing it for the first time, it can be daunting. And there is a lot of value that gets created or lost during this negotiation. You guys are going to work your butts off for the next 10 years building your company. But then this negotiation that you do upfront with your investors can basically mean a lot in terms of what you leave on the table. In fact, one of the companies that we both know very well about, the guy gave up what 70% of his company for 2 crore rupees, and the company is today worth like a few $100 million, like 2 crore rupees. Yeah. So I'm saying this negotiation on valuation is a very critical one, and I'm thinking somebody like Catalyst should play a very critical role in fighting your side of the battle. If you guys get onboarded, I mean, one, they give you a stamp of credibility to say this is IIT Mandi Catalyst. Also, I mean, while they have like I don't know what you guys take, 5-10% for incubating companies, that's actually very reasonable, because I'm thinking they should be fighting your corner when they go to the Series A and so on and so forth, to basically position you properly and basically pitch you at the right light, so you make the most of it. Yeah. Open to questions.
I just have one follow-up question. I think that's a theme for Catalyst as well, is that, we of course look for a problem that the, business is going to solve. There's a solution and there is, that angle to it. But I think social impact, for instance, and you spoke about, affordable housing and low income. So how much does it really matter? Is the world of finance and fundraising all about, money? Is it all about, making bucks and LPs and return on investment? Or is there, I mean, just to again demystify the world for a lot of people who are sitting here, are sitting with social ideas, right? And they're thinking, oh man, I'm not going to be able to give this kind of return of investment back to the fund. So do you have any angle from a social impact perspective? And if it does play a role, what role does it play, honestly? And again, across the board, you have a healthcare, you have a real estate, fund sort of, Dubai, and yeah.
Sure. Look, perhaps I can feel this thing. Look, investors, when it comes to social impact, you have investors of all kinds. On one side, you have philanthropic foundations who just give you grants, right? The Bill Gates Foundation, and so there are lots of foundations which is just write 10 crore checks. Right, if you're doing something meaningful that will change the world, right? And they have no expectation of getting money back, but they will hold you responsible for getting the social impact metrics right. If you say that I'm going to impact 1,000 lives, they'll say, okay, man, demonstrate to me you've impacted 1,000 lives. Yeah. On the other end of the spectrum, you got people who want to tick the box on social impact, the feel-good factor, but they care for 30% IRRs. All right, and you got a lot of those investors. That, in fact, most professional funds, which are social impact funds, will expect market returns, but they are happy to take slightly more risk, and they are willing to go off the beaten path, and they'll put money on kind of unproven models, but they expect market returns. Yeah. Somewhere in the middle, there are also people who kind of like development finance institutions and all that. They're happy to work with 5-10% returns for social impact. Yeah. And so I'm saying it's a spectrum. But that's a card that you can play if you have a strong social angle. Yeah, it's worth considering.
So the way I look at it is actually there are two kinds of investing in that sense. So one is investments which are done with returns as the primary objective, but they also make social impact. The other ones are the investments that are done with social impact as the primary objective, with the returns as also an objective. So, of course, in that sense, every venture capital investment is a social impact because it's creating employment, etc. So, the interesting part is that the one which is done with the social impact as the primary objective, there are very different set of investors for that. So you have, an IFC or a CDC or, FMO, they're global investors who actually are looking for a very huge social impact as their primary objective. From a return perspective, of course, they want to see whether it's a return for them is a criteria to just see what kind of actual impact on the ground is being made, but they're long-term investors. So I think, like for example, we have a company which is actually helping farmers. We have a company called RML, which is working with farmers, giving them information on their mobile phones to help them increase their productivity. Now, when we looked at that investment, it was looked at purely from the returns perspective, because we saw a huge opportunity. Farmers need that. There is a business model around it, and the company is doing really well. But if you look at the social impact part of that, there's a huge value that the farmers are deriving out of that. So they're actually able to take real-time decisions on their crops, so which is actually helping them a lot. So it's a very good kind of a combination of social impact investing with returns expectation.
Also, I think for the entrepreneurs, you have to be very clear as to where your business model is going to be. I mean, you can't play both sides of the equation, saying you're a social impact company and then do for profit, and also go to the right set of investors. You'll find a gambit of investors that are willing to do social impact and ask for returns, or only do social impact and not expect anything but hold you accountable for metrics. Whereas entrepreneurs, I think you have to have a very clear goal as to what your company is, what problem you're trying to solve, and then go down that route.
Yeah, hi, my name is Rajesh, and I'm coming from a startup called Local Guide. We're trying to connect travelers with local experts. So my question is basically somewhat our present situation itself. So for an early stage startup where we try to get the MVP in place, and we also try to get some initial feedback from early customers, it's very difficult to project things on the basis of what we have, because working with an MVP and with very early stage feedback, and because it's new, so there are not many studies to support the data. So how can we credibly base ourselves with the projections and what we believe the market would be, and how do you look at an early stage startup like that?
So good question. I think when you look at new concepts, which is we're talking about very hyper-local, you have to go draw parallel from different businesses or how they're doing, what the unit economics are going to look like, what the volumes are going to look like, and you take some number of that and show the progress. But what you also said, there is nobody else doing that. There are a lot of companies that do similar things, right? And it is very important to draw parallelism from those businesses and understand how you're going to perform in that business. So it is difficult to project your earnings, project your numbers, but it's relatively easier to say these businesses, similar models, did this thing, this is how they grew, and this is how we plan to do it. So, and very often I'll go back to the entrepreneurs and tell them, there are other companies that do that, show me modeled on those bases, and then we go look at the industry whether it makes sense or not.
You have something to say, Rajesh?
Well, look, let me put myself on your side. As I just told you, valuation is a crapshoot, right? What this means is, if you want good valuation, you need to come up with a credible story on why you're going to shoot for the moon. Right? Look, ultimately, your attitude and your vision is what people are buying into. Right? If you basically totally believe that you can basically drive 1 million whatever customers and make lots of money, then people start believing your story, right? Eventually, if you believe in it yourself, right, then the passion comes through to investors. Right? First and foremost, you have to believe the story, and you have to believe that these goals are achievable, right? And which in a way translates to valuation at some stage. Right? But point is, if you basically just throw some numbers in the air, you lose credibility. So you need to be able to back it up on why this is possible. Right?
So basically, we have been running a venture in Kashmir for the last 6 years, bootstrapped it, and for the last 6 years, what we have focused on is building on an ecosystem around the art, craft, and produce of the geography. What is very important for investors also and other people who want to partner with such kind of a venture is that when you're organizing stuff, there is a lot of back-end work that has to be done initially, right? So for the first 3 to 4 years, that is what we focused on, building the back-end. Now, focusing on a geography like Kashmir, what was very interesting about our venture was when we researched about the place that we come from, there are 10,000 retail stores globally selling the product. So the market is already established. It's a $5 billion opportunity. but they're just filling the vacuum. A lot of stuff has not happened. Say, for example, a lot of design intervention which stopped after 1990 when things went bad in Kashmir, right? So we looked at the opportunity. We knew that the market is there, but instead of going directly to market for the vacuum, we started building the backend. It took us 3 to 4 years, but at the same time we did revenue. The point I want to make here is, well, the moment we started interacting with the investors, some of them really came up with some suggestions that irrespective of what work you've been doing in the back end, we should have seen much more numbers in the last 3 to 4 years for your venture. So that was something we really didn't understand from an investor perspective, that if you're trying to really organize the back end, which essentially is basically an ecosystem and not just a marketplace. So marketplace that we have built, let's just say, is just 10% of the story of our entire business. So does that mean that there are going to be certain investors who look at the long-term opportunity? Are there going to be investors who really look at your business and not just look at your business from a numbers perspective? One. Second, so recently we raised an investment for our venture. It's basically a CCD round and it's still open. So I want to understand, is that route that we have taken a good route to go forward? Because we want to go to the next round. We want to raise an institutional round in the next 6 to 8 months, and based on that we have kind of raised a small round, and which is currently an open round. Is that a good strategy to go for?
So I think, of course, a lot depends on your, business. So need to understand that much more detail before I can give any specifics in terms of, what will work in your case. But I think I can take some, some clues from the kind of business you're doing and the kind of stage you're at. Given that, I would say that, while of course, CCD, it all depends on what terms you're giving to the investor also. But typically, also the amount that you've raised and all that also is, but at the face of it, the kind of business you're talking about seems to be making sense, because looks like it's a very specialized product category with a very broad target market, global market. Of course, the devil lies in the execution and the team and the actual model you're following in terms of the actual delivery, and there are lots of multiple things involved there when we evaluate from an investment perspective. But yes, it does make a difference also in terms of who else has invested in you. So, whatever you raised so far, you're raising, suppose there are some names involved who have a name in the market, that does make a difference. So, of course, we also look at that even in our Series A, Series B, who else is investing makes a lot of difference. So therefore, you should choose your investor, as we were saying earlier, very, very carefully, especially at the early stage. So I think that's probably what...
One more feedback. Yeah, am I audible? Yeah. So one more feedback that we have got from our legal advisor, who also happens to be one of our board of advisors, was rather than now at this stage going for an angel investor, we already have 3 angel investors on board. What you should rather do is focus on an institutional investor who can come at an early stage right now and also have the money to put in at a later stage. What are your comments on that?
Getting an institutional investor is always a good thing, right? Institutional criteria for evaluation is far, far more stringent than an angel investor whose IC is spouse, typically. So, basically, if you can attract an institutional investor, there are institutional investors investing in seed stage also, including us. So we'll write a 60 lakh rupee check, for example. From 60 lakh to 60 crore, that's our range. Of course, if we put a 60 lakh check, we'll follow it up. So we'll follow it up. We'll go up to that. Whatever the follow-on rounds are required. So obviously, it's always better to have an institutional investor. But problem is that in the early stage, chances of success with an institutional investor are extremely low. So you have to be also very careful. At what stage you approach institutional investor. But I think if you keep your institutional investor involved early on, then chances are they're tracking you over time. There's a better chance of getting investment from them.
Can I ask how much money do you need? Yeah.
So we are in the middle of raising a 1 crore CCD round, in which we have already raised 50%, 50 lakhs. And then in the next 8 months, we are raising a $1 million round for our venture.
So, and if the business goes to plan, how much money do you need eventually?
So after that, we'll go for a $5 million round.
So you need to raise money continually.
Yes, so
right?
we go to Series B and then we go for the IPO. So basically, most of our business is focused on the B2B segment. That is where the cash flows come into the business. That's how we have been able to sustain for the last 6 years, with all these bans and curfews and floods coming in Kashmir. Thank you.
See, essentially, you need institutional funding if you need lots of money. Okay. Otherwise, look, it's a cost-benefit analysis, right? It's always nice to have institutional backing as a stamp of credibility, but it also comes with a share of pain, right? You need to handle the institution. There will be a bunch of analysts sitting. You need to provide regular MIS, which all is good because it inculcates discipline in your organization, right? But it all depends on your stage of organization, how far you're willing to go for it, right? And perhaps for you, something like crowdsourcing would work just as well, right? Just spread the word with like 1 million Kashmiris out there. Tell them, man, you're making a difference to this valley, and just picking up $1 million is not that big a deal for you if you go about it professionally.
Have you done crowdfunding already on Kettle? No.
So basically, what is very important for Kashmir Box, as the panelists were rightly saying, is the color of the money. So there are a lot of Kashmiris who have that kind of capital. Even just one Kashmiri who has some industries can invest around 20 crores, but we don't see them adding much value. So we are the first startup from Jammu and Kashmir which sells in anthropology stores in the US. So for that kind of a network, so that is what we are trying to build. For that kind of a product, that kind of a network, we want someone who has that expertise. So rather than the money, more than the money, what is very important for us is the people who are coming on board, the kind of connects they come up with. So the investors that we have got, so one of the investors, so basically they own Blue Duck, which is logistics, which is one of the pain points of our business. The second is a senior manager with Amazon in the Silicon Valley. The third is a marketing guy who has headed LG and other big brands in India. So we are really very focused on whom we want to partner and whom we want to get on board. That's very important for us.
What's your name again? Sorry.
Mohit.
Mohit. I would love to have a look at your business plan. Sure. Let's discuss offline.
Sure.
Sorry, there was a question here.
Debt versus equity, how to decide? So when should we go for equity and when should we go for debt? So for example, if I get money my business for 50 lakhs, say, and I see consistent cash flows after that. So should I go for equity in the starting round or should I wait and fund it myself by even taking personal loan or debt? How to decide about it?
So, very difficult question to answer. It's about what risk you're willing to take and who are you allowing to participate in your business or your concept that you're trying to build, right? You take debt when you're sure enough that the risk is minimal to the business, and the amount of debt you want to take is the amount of risk you can take. As entrepreneurs, you're already taking a risk because you're not taking full value salary, you're putting in more hours, you're trying to build that business. So I think it's a very individual decision of when you want to take a debt, especially at the early stages of the company. Down the road, you will have options where you will get the equity funding and you'll have the option of raising debt as a part of the equity round. Right, but early on, I would recommend know your risk profile, how much of risk you're willing to take, what you're willing to bet on this company, and then who else do you want to be involved with this risk-taking effort that you're taking, right? Because you're already taking a huge risk when you start something on your own.
It's also very, very important if you decide to take debt, who you're taking debt from. I remember 3 o'clock in the night, one of the entrepreneurs called me, woke me up in the middle of the night. He said, "Can you help me?" I said, what happened? I took debt from these guys, 3 crores, and they're after my life now. I can't return. So, of course, I can't help such people, but I think don't get into that situation where you're taking loan from people who say, just leave your name and we'll figure it out, how to take it back from you.